Well, the latest Forward Perspectives is out, and it is titled Debt, a Cause for Caution. This, of course, comes out from the TD Wealth Asset Allocation Committee. And Bruce Cooper, Chief Investment Officer at TD Asset Management, is here to take us through the note and what is important. Nice to see you.
Great to be here.
Okay, debt, a cause for caution. Just give us the big picture on this. Why did you take a deep dive into this?
Well, debt has been one of our principal focuses since the committee was founded back in 2009. And I think really the reason is we think high debt often creates an environment of low growth. And low growth is something we need to think about as we're thinking about returns of all asset classes. So we just wanted to dig into where we stood today with respect to debt and what the implications of that might be for growth and returns in different asset classes, as well as for risk for our clients.
Okay, so if we take a look at the first page, and I have my copy with all my notes here, debt is climbing. That's the first thing you want to point out. So give me some numbers around that. What are you seeing?
Yeah, so we looked at global debt to GDP. So we're not looking at absolute dollars of debt because you need to relate it to something. We think GDP is the right thing to relate it to. Today, that's 236%. When we entered the financial crisis, whatever that was, 7 or 8, 9 years ago, it was around 200%. So despite the fact the economy has recovered, which means the denominator in that equation, debt to GDP, has actually been growing, despite the fact the economy has recovered, debt continues to grow. And if we dug into that a little more, what we'd find is that particularly in the emerging world, it's growing, places like China, but also here in Canada, we know that, for example, household debt has been increasing. So interest rates have been low. That's incentivized people to take on debt, and debt has continued to grow really since the crisis. And if you looked, as we do in there, over the last 50 years, debt to GDP is at a pretty high level. And
you actually highlight as well, too, with China specifically, 240% of GDP. That's where debt lies.
That's right, and that's a big, big increase over the last 10 years. I think what's happened in China is they've wanted to continue to have fast economic growth in order to keep people employed. And as the world slowed around the time of the financial crisis, China put in place a big, big stimulus program, and that involved infrastructure spending, especially, as well as real estate development. And both of those are kind of debt dependent. In the case of infrastructure, that was the government borrowing to build things like railways and subways and roads and that kind of thing. And of course, real estate in China, as in most places, there's a lot of debt financing that goes on. So a lot of the growth in China in the last 7 or 8 years ultimately has been underpinned by quite a large increase in debt.
Now, one of the theses that you present here, of course, is the idea that the more debt you have, that the slower the growth is. Can you just explain why, like just in really basic terms?
Yeah, so what we found is that when debt gets to a certain level, and we've tended to look at debt at the government level, so we call that sovereign debt to GDP of 90% or more, so that's a little different than the first graph, but government debt of 90% or more to GDP, you tend to get a period after that involves slow economic growth. And Reinhardt and Rogoff did a big book, 7 or 8 years ago that looked at this over the past 400 years, and that was the conclusion they came to. As we've done our research, we've looked into that, and it appears to us that when debt gets too high, it tends to depress productivity. And productivity is one of the most important underliners of drivers of growth. And the reason productivity gets depressed is that during credit cycles or credit bubbles, resources tend to get allocated to sectors with lower productivity. Real estate might be a great example.
Interesting. And I would think as well, too, just from a simple perspective, I mean, if you're using money, resources to pay off interest, you're not using it to pay off or to invest in what you're actually doing at the same time.
That's very true. You get on what you might call the hamster wheel.
Yeah.
You're just generating cash flow to pay off debt. It's hard to look forward at that point.
You mentioned as well, and you've got a subsection here talking about igniting volatility, which we all know we're in it right now. So what is the idea here? Is that you mentioned kind of resources moving from sector to sector.
Yeah.
So what's causing volatility?
Debt's kind of like an iceberg out there. It's floating. Sometimes the seas are calm, and we know in a year, in the markets, there'll be some periods that are calm and some periods that aren't calm. So we're not saying volatility will always be high. But there will be episodes of volatility is the way I think of it, and that's because this iceberg of debt is floating around out there, and once in a while someone hits it. And I think what debt does in a more practical sense, aside from the iceberg analogy, is that it connects us to different people around the world. And so if, I think we use the example in there, if Russia defaults or if Greece defaults, you might say, well, why should I care about Greece? It's a pretty small country. It's a long way away. But if I hold Greek bonds, of course, their default means that I've lost money, which means I might have to sell something else.
Which puts pressure on other markets.
You get this contagion effect that goes around. And with the high amount of debt we've got around the world, that means that there's a lot of interconnection in the financial world with all these different assets. And one person's problem can translate to becoming another person's problem pretty quickly.
You also talk about, in one of these graphs or figures, corporate borrowing versus investment.
Yeah.
And so the idea again here is that we've seen a drop-off from what you're looking at in investment despite higher borrowing.
Yeah, so it's one of the interesting conundrums, I guess you'd say. It appears to us that investment has not been strong. It might be because there's not strong demand in the world. So companies are saying, well, why would I want to build another factory when I'm already operating at low capacity in the factories I have?
Right.
So we're not getting big investment, but at the same time, interest rates are very low. And so some boards of directors are saying, well, gee, I can borrow money, pay low interest, and buy back a lot of stock. And so to some extent, there's been not too much investment, but a fair amount of financial engineering. And to some extent, that's not a bad thing. If your stock is very, very cheap, but you can borrow to buy back stock, I think some of that is okay. But in the long run, obviously, as an investor, what you really want is cash flow. You want companies that generate free cash flow, and for things like dividends and share buybacks to be financed out of free cash flow. And that's a healthier situation than using debt to finance things like dividends or share buybacks. Okay,
so given all that, let's land the plane for the people who are watching. What do they do with this? I mean, how do they manage going forward?
So I think there's a few things I would really like to highlight if I could. I think for investors, you want risk management, to be at the center of your process. That means understanding the way your portfolio is constructed. If you got the right risk of Canadian equities and global equities and bonds, and are you being paid for the risks you're taking? So this is not a time to swing for the fences. This is time to have a tight risk management process and really understand the portfolio that you're managing. Second, diversification. It's one of those old cliches, but it is true. I think diversification is your friend in environments like this. Bonds will obviously do well in certain environments. I think global equities can be very powerful. The Canadian equities performed relatively poorly the last few years. Early this year, actually performing a little better relative to global equities. So I think diversification is very much your friend. The range of outcomes is fairly wide, so you want to make sure you've got that diversified portfolio. And then finally, I think very much what we always talk about, a focus on quality. I think this plays very much to our strengths for sure. When we think about quality, we think about companies with strong balance sheets, consistent cash flow, high returns on capital. These are the kind of companies, it's a tough environment, but some companies would be very successful. And I think if you can focus on those kind of companies that can grow their cash flow, grow their dividends, pay good dividends in this lower return world, those are the kind of companies you want in the portfolio. So, those three things, risk management, diversification, focus on quality, I think that will help you navigate this relatively challenging environment.
Bruce, always a pleasure.
Great to be here.
Bruce Cooper, Chief Investment Officer at TD Asset Management. I'm Kim Parlee. Thanks so much for watching.